Markets finished the week strong today with some tweets coming out from the administration about the possibility of no new tariffs, right, for the between the U.S. and China and their trade war with each other. That had a positive impact on sentiment heading into the weekend. We got a long lower shadow alert. So I'm going to break down what those things mean heading into and what the seasonality tells us heading into the end of this month with Thanksgiving next week and then the holiday and then the Christmas and New Year's holidays coming up at the end of the year. How that impacts our market posture and expectations going forward, and what sectors we expect to do well during that rally with a trade idea in one of them today. So let's go ahead and get started. Today is Friday, November the 16th, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. Two-day winning streak to finish up the week here. Essentially reversing the loss that we had on Wednesday down to that low. We did get to a lower intraday low yesterday before reversing with the piercing line pattern that we had on the S&P yesterday. Sorry about that. And then, of course, closing up higher would have, we did close a smidgen. Like the high of this candle, yesterday's candle was 27.35. We close at 27.36. The 38% range is right also of this near-term retracement. So the Fibonacci retracement zone is also at about 28.35, and you can see we closed a smidgen up above that, 27.34 looks like. So it was a bullish close, not as bullish as if we had a close like say up above like 27.50, and then that's obviously solidifying the close above the high of the low day and solidifying a breakout back up to the upside out of this Fibonacci retracement zone. So not quite there yet, but better than being down here, below the 62%. So more bullish. It's not bearish, but it's also not quite as bullish as you'd like to see yet. Probably means you might not get a near-term high. In fact, I would doubt we'll get the next near-term peak on the S&P above the last one. Because of how much we pulled back to the 62% retracement. I wouldn't be surprised if we peaked up in this area right around 2,800, maybe a little bit lower than that, 2,775 to 2,800 before pulling back after a short and then getting a new higher near-term high point, say around 2,750, that you could bounce off of and then make your way into a new bullish intermediate run, which would be, again, similar to what we saw over here. Over here, the next one pull back down to a lower low point, and here I wouldn't expect that to happen. I would expect it to stop, like in this area, and then rally and start the new intermediate run. So that's kind of what I'm looking at and expecting. Keep in mind, by then the volatility index had moderated all the way down to below that neutral zone, into the bullish zone. By that early May period. And I'll show you that here when we get to the volatility charts. Not quite the same here. That's why we're getting more volatility now compared to back here in late April, mid to late April. Volatility is higher, so you're getting bigger ups and downs. Don't get so caught up in the big moves, either to the upside or the downside, that either, number one, you think, here we go again, back up the truck and let's load up on bullish trades, or number two, the world is going to end. I know that seems like the binary nature, and you can see that in the comments of the video and social media and all over the place. Either the market's going to the moon or it's going down to zero. It seems to be a very binary nature in at least those who talk about the markets. All right, but the reality is that's not the case, and you'll probably get some near-term volatility because, again, of how high that VIX is. Something to keep in mind, here a couple days ago, it was actually on Wednesday, there was a lot of tweets going out about, where are the buyers at? Where are the buy the dippers? The buy the dipper is going to run out of cash. And then this market's really going to tank once the buy the dippers run out of cash. Just to keep in mind, retail investors don't buy the dip, right? Retail investors buy the rallies. They buy all-time highs. That's what retail investors buy. Institutional traders are the buy the dippers. And institutional traders don't run out of money, right? They have a lot of cash available to buy, and they continually get more cash as people continue to put money in retirement accounts and such. So, those are the buy the dippers. The reality is the retail investors actually sell down here. They sell when things get really bad, and they short when things are the most bearish. And so when you see that, oh, here we go with the buy the dippers, and they're going to run out and we're going to really fall. Keep in mind that if institutional investors don't buy this dip, it won't be because they ran out of cash. It'll be because they don't see the upside potential. Right? It won't be because a bunch of me's and you's ran out of cash to implement in our little portfolios compared to what these institutional buyers are managing. All right, we'll take a look at the Dow Jones Industrial Average, and you see, a very good, similar close above the high below day there. Again, not quite out of the Fibonacci retracement zone to the upside. Near-term lines back up above 50. The Nasdaq Composite not as bullish. It is, back up to the 50% retracement after that piercing line yesterday. Near-term line up above 50. Bearish posture still, and same thing on the Russell 2000. So short-term sentiment's improved. It's not improved enough to say, hey, let's, next week is going to be we're going to be threatening those highs next week on a short holiday week. The reality is we're probably not going to get. We're probably going to get stuck if we do keep going up early next week, which is what you'd expect because of the short-term sentiment, that we'll probably get into this area here across all these major indexes around Thanksgiving. Now remember, from a seasonality standpoint, this is a bullish time of year for here we go. This is a bullish time of year for the S&P 500. Right, this week, right, this period here from the 13th up through the 29th, we typically have a little bit of a run, and you can see, from the 6th to the 5th to the 13th, we tend to be a little bit more bearish in November heading into that expiration. That's what we saw here. You also see too, as we diverge away from the 20-year average, we tend to come back down pretty quickly in either direction. When you get down too far below it, we tend to rally pretty quickly back up to the average. So now we're down below it. We've kind of diverged from it, and you would expect during a bullish time of year that we'd rally back up closer to it. Now again, whether that gets up to these 2,800 levels or not, that's what it would take to get back to the average return for the year over the past 20 years. Remember, which includes two big bear markets over that time frame. Okay, before we look at some other charts, a reminder to subscribe to our YouTube channel. You can mouse over that logo right there in the bottom right corner of your video, then click the red subscribe button that pops out. Also, click the thumbs up icon down below the video. That tells us two things. Number one, you got something out of the video tonight. You learned something. Number two, you want us to do it again on Monday. Really simple way to give us feedback. You can do it with one click, and you can do it right now while you're watching. Also down below, comment on anything that stood out to you. Join our daily Market Outlook email list. There's a link popping out in the top right corner of your screen. Click that link to subscribe. Very easy way to do that. Follow me on Twitter for more content like this throughout the day. Join our community, our Market Outlook community that we created on Facebook. Also, on the blog post, click this heart right underneath the video on tonight's Market Outlook tweet. That will pull up the separate window. You can click that like button. Also, click this image here that takes you to your Facebook account. You can also like tonight's Market Outlook video from there. And then finally click that like button. When you click those three things, again, another really easy way that you can do right now to tell us you want us to keep doing these videos. If you don't want us to do these videos anymore, then just don't click on any of those three. That's the only way we get the feedback from you. Also, remember too, you can participate in our forums right above the video by clicking on that link. Remember to participate, you have to subscribe. You can do that for free by clicking right underneath Join Market Scholars. Click on that image there. All right, back to the charts here, and you can see on the weekly chart, I tweeted this out earlier today. We got at the market close, we got the long lower shadow again. So a very bullish pattern. They get these long lower shadows. They tend to be pretty bullish. And we also finished the day above 2731, which is significant in that's where this 40 period weekly moving average is, 40-week moving average, which is equivalent to the 200-day moving average. So good sign for the markets there. Stuck in the middle between this falling 50 and the flat 200 now with long lower shadows. Again, the expectation would be that we'd break up. Now, we're going to get up to a new MACD high point. Highly doubt it, because that's you tend to converge your way down as these lines compress. So I would expect us, as we've seen before, to come down and then bounce back up again. Come down, bounce back up, come down. We'd expect it to bounce up, just not to a higher level than what this peak was. So keep that in mind. That was a pretty decent move over the middle part of this year. And you can see similar, the Dow is still above its 200. The NASDAQ, a long lower shadow, a good sign. The same thing with the Russell. This is actually the first lower shadow that's relatively longer for the Russell that we didn't quite get on previous weeks. And as I mentioned before, we got the pink shading, which typically sets a low point, right? You after you get the death cross or a golden cross, you make a return move back to the 200-day moving average. Here you made a couple, but you initially make a return move back to the 200-day moving average after the cross. So we'll see, once we make that return move back up, if that's what we get, if it holds, then we bounce, then we'll be bearish, right? But again, considering all the other factors, we wouldn't expect it to hold. We expect it to get back up above the 200 and work its way back up again, just not significantly higher, right? So if you look at the 3 green arrow chart, then you notice that we got 3 green arrows still. We don't have the 1 green arrow still. We don't have the MACD didn't get below its moving average. Stochastics is falling, but you also see too that we also kind of failed today at the 8-day moving average. After having come back down through it to the downside, we kind of failed below it. But you see the big time higher low that we're getting even on these moving averages. So should a close up above these highs, which this is a daily chart, mind you, and you're right back above all 3, and a really good sign for these 2 lines to make their way up above the 30-day as well, which is a bullish reversal. And I've talked about that before. When you get this convergence up, and here's that late April again, you typically don't get to those higher levels immediately. You come down first, and then you make your way higher again. And so we're seeing a very similar setup forming right now. All right, now let's take a look at the intraday chart, and you see we did get a higher high and a higher low. We closed up above yesterday's high. We closed right at the open of the Hakinyashi candle, so interesting pattern there. And we are still up in the upper half of the 4-week chart, so this would be shaded green too if we did that. So a bullish candle. You can see the near-term bounce coming off that 62% retracement level, and again you also see we're just a smidgen outside the upper the Fibonacci retracement zone. If we can get above this 275, like these peaks here, then you have a better chance to make your way back up towards the top end of this 4-week range. We look at today's volume and trading range. So no gap today. The range is below is below average, and the volume is right about at the average at 125 million. So put that in context. 3.5 points is down here. So that's a good sign to get this line coming down. That is a little bit more than 1%, so it's in this area. So that would bring this down to, and then the volume 125 million right here. Expect that to come down, especially next week. Volume tends to be really light the week of Thanksgiving. All right, now let's take a look at the volatility index, and you can see we are coming down from roughly a little bit of a higher high, right? If you consider this a high, lower highs, lower lows, and then a little bit of a higher high. So we'll see how much further down we go if we end up threatening that low point, or if we get to a lower low at 15. 15 will most likely act as a support level as volatility does moderate still. You can see we're back down to 95%, so there could be some support here in volatility early next week. That's why I say there could be some near-term choppiness early. We might not be headed to 2,800 immediately, but I also don't think we're headed below 2,700 either on any near-term choppiness that we get. It'll be kind of up and down within a smaller range from what we've been seeing here the last few near-term ups and downs. So, but again, that we've seen this 3-act play out before. We're in the 3rd act of volatility moderation. It doesn't complete until you break below that 90% level. And that's where we were at the end of April, and that's not quite where we're at yet. So expect still some more ups and downs in the near term, just not to lower lows, right? We would be, expecting moves eventually to break out back towards the upside, and this eventually to work its way towards 12 and then 15, and then make your way down below it. That's when volatility is moderated. When it gets below 90 and this hovers in this bullish zone, which is most likely going to be around 15 with a little bit above or below. That's when we know that volatility is moderated and this bullish intermediate run has really taken hold and taken off. All right, so to summarize, we've had our near-term pullback this week, and we were looking for that's that time of year. You know, it's the week of November that typically is. We've seen from a seasonal standpoint as bearish. We were looking for that near-term pullback. It came down a little bit further down the 62% Fibonacci retracement. Because of that, you know, I do expect some more near-term ups and downs. I don't think we're going to jump right back up to a new near-term high up above 2,800 before we get another up and a down move in between. But that doesn't change the fact that, you know, I do believe that we're closer to a new intermediate run and the new bullish intermediate run starting here, whether it's this week or next week or by the end of the year, or at least by the beginning of December, excuse me. So that's what we're looking at based on the market forecast and all these other technical indicators. What do you think about that? Do you agree with that posture? Click that poll that's just popping out right there in the top right corner of your screen. Then click either agree or disagree. If you click on disagree, scroll down to the bottom of the YouTube page, comment on what you see that suggests something different that you may be seeing. That either you might be more bearish than our posture tonight, or you might be more bullish than the near-term volatility I'm expecting. So if you see something there that you want to share with the rest of our community, make sure you share that down below in the comment section. All right, now let's transition into what's driving the market here, and you can see this is over the past week. Well, first today you can see real estate stocks, agricultural stocks, crude oil, gold. You know, all these kind of anti-dollar trades did really well. The dollar is something that we've expected to pull back, and it pulled back the most today and allowed these kind of anti-dollar trades to do so well. And you can even see with the S&P up, long-term bonds rallied with yields falling. So there's small cap stocks in the S&P kind of matching each other all week long. Down here, crude oil had that big decline early in the week, that capitulation drop on Tuesday. Since then, you know, it's up about 3 or 4% or so. You can see small caps and large caps rallied here from early Thursday morning up to the close off of that early Thursday low. So did emerging markets, finishing the week higher, and of course the dollar starting the week strong here in blue and then finishing down with today's drop, finishing lower. EFA underperforming emerging markets, and you can also see two high yield bonds lagging behind treasuries, and really that doesn't seem to be a risk off type of a move, even though stocks were down on the week, but you know, it seemed to be a pretty decent rally here for equity, especially at the end, and for emerging markets in particular. They actually had finished with a strong week higher. When everything else kind of went down here, they rallied before, you know, they were already up by the time the U.S. hit their lows for the week, U.S. stocks. So not exactly a risk-off pattern, which is typical when you get pullbacks. They're not necessarily completely risk-off type moves. And like I said before, to see the dollar making that kind of more of a reversal pattern here after kind of this false breakout move up above 97, making our way back down and breaking down below these past couple of days lows with two red arrows. And then if you look at the two-line version of that chart, pull up DXY for the MACD and stochastics, you can see the big divergences on that false breakout move. You know, lower highs. So you know, so there's opportunity for bearishness here in the dollar. Of course, breaking below 94 will be the real move to the downside, because again, there's your Fibonacci retracement zone of this kind of bounce that we've had this year. We've gotten up into above the 50% mark of the retracement zone, but not getting up through it. So so the dollar being bearish, and as I mentioned before too, and just a quick reminder for those who haven't seen, the markets here, these foreign markets, have really lagged behind the U.S. for most of the year until now. Till recently, the U.S. markets kind of caught back up, but they're starting to show some resiliency. You can see India, China above its moving average, Russia above its moving average, Korea getting above its moving average. They're still falling, but India's moving average now is rising, and so is China's. Brazil is still up, bouncing back up above its moving average. And you can see Europe is still lagging behind, but they're settling into a low point. You remember all these clusters on the daily chart, but there's a lot of these clusters too on the weekly charts, very similar to early 2016, where international stocks led the U.S. stocks higher for a couple of years. Remember, the Fed raised rates for the first time in 2015, which was significant. Probably more significant. That 25 basis point hike was probably more significant to investor sentiment than the December hike will be this year, as it will just be another one this year. But back there, it was a significant change in monetary policy, and that put some pressure on these stocks. That they kind of made that last decline with the death cross on the S&P and the Russell. But then all those really oversold international markets really took off. And again, I expect a similar pattern to develop with weakness in the dollar. I expect that similar pattern to develop here as we head into the end of 2018, early part of 2019. All right, when you take a look at the sectors and how they performed today, you can see with the dollar being down and bonds rising, those interest rate sensitive areas really bounced up to most, and they've been leaders here. You can see utilities and real estate getting close. Utilities really close to its 3-month high. Utilities making its way back up. This is the sectors according to the new sector selector rankings that are out on our blog, so check that out. Premium subscribers can dig into that blog post and see the details for the industries, for the stocks within those sectors, as well as the details of what goes into those rankings. So check that out. But you can see that healthcare did well. Energy, materials, dollar sensitive areas. With the dollar down, they rallied up. And if you look at these charts down here at the bottom, not financial so much, but materials, industrials, and energy, they all look very similar to a lot of those international areas because they make the same move. So if we expect a weakening dollar to help out those international areas, then these sectors typically will go along with them. So we'll expect some outperformance out of those. You can see the typical leaders during bull markets. At least a lot of people, put a lot of stock into discretionary technology and communication services now. With some of the stocks being moved here, you can see how they're lagging. They haven't bounced as much as like materials has as these interest rate sensitive areas, as even healthcare has. So we can see the bullish sectors. If the market's going to get bullish here, we can see which ones are bullish. We can also see which ones that will still go up, but they just won't go up as much if the dollar were to continue to have that weakness. We just won't see these particular areas go. There'll still be some opportunities for gains, but relative strength will be in some of these other sectors. One stock in that space is Chevron here, that started the week with a gap to the upside and initially fell way down, but look at that long lower shadow and closing back up near the 200-day and above the 50-day moving average with the gap, the negative gap we have between those two lines rising back up. Remember, when you get a death cross, you typically will make a return move back up to it, and looks like this return move this death cross end up being marking a low point, potentially marking a low point, similar like what we talked about before, if this return move doesn't hold and we continue to move higher, which we would expect considering the industry, the sector, and the weakness in the dollar. And that's really helped fuel a lot of the strength you've seen in Chevron here in the last few days. With this gap, the close today up above the last few days high. So there's our open at the beginning of the week. Really strong open to the upside, kind of where we finished last week, but then coming down, new near-term low, similar to markets, but and unlike the markets, we got a stronger close today, and that gave us the near-term line in the upper reversal zone. So positive development from that perspective. You take a look at some of these other technical charts. You can see where we hit some volume support down here at the bottom, and we're working our way back up towards the top end of this range, getting back up above the moving average in this kind of wide band. So we're going back and forth, but now to the upside. And then finally with the DMI, pattern, here we go. You saw that nice move today on McDonald's as well. But oops, not DMI there, CVX, there we go. The DMI is forming a crossover potentially below 25, setting up for a breakout move for the blue line to get up above. So when you look at some of these other charts, you've got the higher low on the oscillator setting up for a move back to the upside with a green arrow here on the stochastic extreme indicator. So these, this combination of a green histogram today and that green arrow is a bullish sign, and you'd expect a crossover here for the blue line to get up into the upper reversal zone. And then if you look at the market forecast again, the 3 green arrow chart is what I want to look at. The last chart, getting above the 30-day moving average, the 8 and the 17-day both crossing above the 30-day moving average too. MACD bouncing back up, stochastics potentially with a phantom green arrow. So you got a really improving technical situation, an opportunity to sell the 115 put here in December, buy the 110. 115 is at the low of, the low right there. So your stop order is going to be down below that low point. That's the low point of this long lower shadow, which will act as a support level. So we get a little less credit than what we want, but still enough to make the trade worth the risk of the trade, especially with the benefit of the sector analysis that should help with weakness in the dollar, the intermarket weakness in the dollar, and the sector rotation, which you would expect to be bullish for this particular sector at this cycle, at this time in the economic and business cycle, stock market cycles, would lead to bullish expectations for this stock heading into the end of the year. All right, so that wraps us up for today. Thank you, as always, for watching. Remember to subscribe to our YouTube channel, click the thumbs up icon down below, and comment on anything that stood out to you tonight. Follow me on Twitter for more content like this. Join our Facebook community we created for the Market Outlook video, and you can also subscribe to our website for free and participate in our forums, in our Market Outlook forums, be able to chat with other market scholars about what you're seeing on the video and off the video, and ask any questions or comments that you have. So again, have a great rest of your weekend, everybody, and we'll see you all on Monday.